Welcome to the Deep Dive. We're here to take complex information, unpack it together, and really get to the core insights.
And today, we're diving into GameStop Corp, a company that's certainly seen its share of market attention.
Definitely. Our guide is their latest quarterly report, the Form 10Q, filed for the period ending May 3rd, 2025.
Right, so that covers their first fiscal quarter. Just ended.
And look, this isn't just some dry financial document. It's really the story they're telling us, how they're doing, the strategic moves they're making, where they're putting their money.
Exactly. Our goal today is to kind of walk you through it, pull out the key numbers, but also the strategic shifts that really matter. What's GameStop actually doing?
Think of it like looking through a window into the company right now.
Let's do it.
Okay, so setting the scene. We're talking Q1 2025. For GameStop, that's roughly February, March, April.
And they're a specialty retailer, mostly gaming, but expanding operating segments in the US, Canada, Australia, and Europe. Fiscal year ends around the end of January.
Right off the bat, what's the headline number, the big change?
Well, the most striking thing comparing this quarter to last year, profitability. They went from a net loss last year to pretty significant net income this time around.
That's the story, isn't it? Net income for the quarter ending May 3rd, $44.8 million.
Yep, and compare that to the same quarter last year, ending May 4th, 2024, they lost $32.3 million then. So that's a big swing.
Huge swing. And the earnings per share reflect that too.
They do. Basic EPS went from negative 11 cents to positive 10 cents. Diluted negative 11 cents to positive 9 cents.
Okay, now here's the interesting part. You said profitability appeared, but how did that happen if overall sales actually went down?
That is the question, isn't it? Because total net sales did drop. They came in at $732.4 million for the quarter.
Which is down from what, about $881.8 million last year?
Exactly, a 16.9% decline, almost 17%.
And digging into that, the core gaming stuff was down quite a bit.
Yeah, hardware and accessory sales down over 31%. Software sales fell nearly 27%. Those are big drops.
But there was one category that bucked the trend.
Right. Collectibles. That category actually increased sales by 54.6%, a really big jump.
Wow, 54%.
Yeah.
From $137 million to over $211 million.
Yeah.
That's substantial.
It is. And geographically, sales down in the US, Canada, significantly down in Europe. Only Australia saw a small increase.
Okay, so lower overall sales, but higher profit.
Mm-hmm.
It's Green's strategy shift, right? How did they manage that margin?
It points directly to two main things: improving the gross margin and cutting costs. Let's look at the margin first.
Good.
Gross profit itself was up slightly to $252.8 million from $244.5 million. But the gross profit margin, that's the key, it jumped significantly.
How much?
From 27.7% last year to 34.5% this quarter.
Whoa! That's a big jump in margin percentage. What's driving that?
The report says it's basically a shift in what they're selling, moving towards higher margin stuff.
Like those collectibles we just mentioned.
Exactly. Collectibles went from making up about 15.5% of their sales last year to almost 29% this quarter. That's a big mix shift.
And pre-owned items, too.
Pre-owned hardware and accessories also grew as a percentage of sales. These categories generally carry better margins than, say, brand new consoles or software.
So, sell less stuff overall, but make more profit on the stuff you do sell. Makes sense. Why are collectibles typically higher margin?
Well, often it's about sourcing, perceived value, maybe less direct price competition compared to a new game console everyone sells. Things like trading cards, apparel, unique figures. There's often more room for markup there.
Got it. So focusing on higher margin products was key. What was the other big factor in getting to profitability?
Cost cutting. Plain and simple, their selling, general, and administrative expenses, SG&A, were cut dramatically.
How much did they shave off?
Down $67 million compared to last year. That's a 22.7% decrease, down to $228 million from $295 million.
That's a huge reduction. Where did those savings come from?
The report mentions a few areas. Labor-related costs, consulting fees, marketing spend. That was about $25 million in savings. Then store-related costs and depreciation also fell significantly by about $21 million and $11 million, respectively.
And that connects to their store strategy, right? Closing stores, exiting some countries.
Precisely. Those lower store costs reflect their ongoing, optimization of their physical footprint. We know they exited markets like Austria, Ireland, Switzerland, Germany, Italy before.
And this quarter, there was news about Canada and France.
Yes. On February 18th, they announced plans to divest, basically sell off, their operations in Canada and France.
So what does that mean when you see it in the financial report? Divesting.
It means when they decide to sell a business unit like that, the assets and liabilities tied to Canada and France get reclassified on the balance sheet. They're labeled held for sale.
Ah.
Okay.
So they're treated differently accounting-wise because the plan is to sell, not operate long-term.
Exactly. And that reclassification can sometimes trigger impairment charges, which we saw here.
Right. The report mentions a $35.5 million impairment charge in Q1 related to Canada and France.
Yep. $18.3 million for Canada, $17.2 million for France. And it notes the Canada sale actually happened just after the quarter ended, May 4th. France is expected later this year.
So shedding those international operations directly helps lower those ongoing SG&A costs.
It does. Fewer stores, fewer employees, less overhead globally. And it's not just international. They're still closing stores in the U.S., too.
They closed a lot last year, didn't they?
590 U.S. stores closed in fiscal 2024. And the report says they expect to close a significant number more this year, fiscal 2025.
So aggressive cost-cutting, store closures, international exits, all contributing to that profit swing despite lower sales.
It's a clear strategy of consolidation and focusing on profitability over just top-line growth.
Okay, let's shift gears to something else that really jumps off the page. Cash. Their cash balance.
Oh, yeah. This number is pretty staggering. As of May 3rd, cash and cash equivalents stood at $6,385.8 million.
$6.3 billion. How does that compare to before?
Well, a year ago, it was just under $1 billion. And even at the start of this fiscal year, February 1st, it was $4.76 billion. So it grew a lot, even just during the quarter.
Over $5 billion more cash than a year ago? That's an enormous war chest. Where did it all come from?
Well, cash from operations was positive this quarter, which is good, but the vast majority of that increase comes from capital raising activities.
Meaning selling stock and taking on debt.
Primarily, yes. The report references those at the market or ATM equity offerings they did last year, May, June, September 2024.
Right. Those let them sell shares into the market over time. How much did they raise from those?
About $3.47 billion in gross proceeds combined. That's a huge part of the cash pile.
Okay, that explains a big chunk. What
Yes. The other major event this quarter was a debt issuance. They sold $1.5 billion worth of convertible senior notes.
Convertible notes. Due in 2030, it says. But with a 0.00% interest rate. How does that work? Zero interest.
Yeah, the convertible part is key. It means the bondholders have the option, under certain conditions, to convert that debt into GameStop stock in the future.
Ah, so the potential upside of getting stock makes the bond attractive even without traditional interest payments.
Exactly. It's a way for GameStop to raise cash now without immediate interest expense, though it does create potential dilution for shareholders down the road if those notes get converted. And that $1.5 billion shows up as new long-term debt.
Okay, so they've built this massive cash position from selling stock and issuing this convertible debt. And the report is pretty clear about one very specific new thing they plan to do with some of that cash.
Right. Investing in Bitcoin. This is a major strategic development outlined in the report.
Tell us about that. They changed their investment policy.
They did. On March 18th, the board authorized a revised investment policy. It sets up an investment committee, which includes the CEO, Ryan Cohen, to oversee this.
And the big change in that policy.
The board specifically approved adding Bitcoin as a permissible Treasury reserve asset on March 25th.
So allowing the company to hold Bitcoin on its balance sheet.
Yes. And the policy doesn't set a maximum limit on how much they can buy, and they can also sell whatever they acquire. It's pretty open-ended.
And this wasn't just a theoretical change. They actually did it, right? It's in the subsequent events section.
Correct. This is crucial. The report states that after the quarter ended, between May 3rd and June 10th, the company went out and purchased 4,710 Bitcoin for cash.
Wow. So they put the policy into action pretty quickly, using that big cash pile to buy crypto.
It confirms they're executing on this new strategy. It's a significant move for a retailer.
What does that signal strategically? A company like GameStop buying Bitcoin as a corporate treasury asset.
Well, it signals they're willing to use their, substantial cash in non-traditional ways, seeking potentially higher returns, perhaps, outside of just running stores. But it also comes with much higher risk, obviously, given Bitcoin's volatility.
Yeah, it definitely adds a new layer beyond retail operations. Sort of an asset management component now.
You could kind of see it that way, focused on a very specific, volatile digital asset. But yeah, it's managing capital beyond just inventory and store leases.
Okay, beyond those huge financial shifts, Any other operational bits worth noting?
Well, they mentioned the collaboration with PSA, the grading company, for collectibles. That makes sense given the jump in collectible sales we talked about. Helps them lean into that higher margin area.
Right, fits the strategy.
The cash flow statement details also support the story. Solid cash from operations, about $192 million provided, helped by managing inventory and payables. And then that huge inflow from financing, the $1.48 billion, mostly from those convertible notes.
Gotcha. And there were some details on executive compensation later on.
Yeah, subsequent events included approvals for new equity awards for their general counsel and principal financial officer tied to future stock price performance. Just details on governance.
And share count.
Around 447 million shares outstanding as of early June.
Okay, finally, let's touch on risk. Big changes like these massive cash, new debt, buying Bitcoin, they must change the company's risk profile significantly.
Absolutely. The 10Q specifically updates the risk factors. And the big new ones relate directly to these moves.
Like the Bitcoin investment.
Exactly. They highlight the risks there. Extreme price volatility, potential regulatory changes affecting crypto, the complexities of accounting for digital assets, security risks like hacking or loss of keys, and the simple fact that Bitcoin itself doesn't generate income. It's purely a bet on price appreciation.
Makes sense. And the new debt, that $1.5 billion.
That brings its own set of risks, too. Having that much debt, even convertible debt, can limit their financial flexibility. There's a risk they might not be able to repay it or settle conversions in cash if needed.
And potential dilution.
And potential dilution for existing shareholders if the notes convert, as we mentioned. Plus, it's debt of the parent company, not guaranteed by the operating subsidiaries, which affects its structure. These are real financial risks they didn't have before taking on that debt.
Okay, wow. A lot to unpack there. Let's try to summarize the key takeaways from this deep dive.
All right. Big picture. GameStop swung to profitability in Q1. Not because sales boomed, they actually fell.
Right. Profitability came from, number one, better gross margins, largely thanks to selling more high-margin collectibles.
And number two, aggressive cost cutting. Reducing SG&A significantly through things like store closures and pulling out of international markets like Canada and France.
And alongside that operational shift, they built up an enormous cash reserve, over $6.3 billion.
Mostly fueled by selling stock last year and issuing $1.5 billion in convertible debt this quarter.
And maybe the biggest headline strategically.
Yeah.
They formally decided to invest some of that cash in Bitcoin and then actually went and bought a significant amount, over 4,700 Bitcoin, right after the quarter ended.
Yeah, that's a major move. So the report really paints this picture of a company trying to stabilize and streamline its traditional retail business while simultaneously using its large capital base to explore, well, very different, potentially much riskier avenues like crypto investment.
It's like they're running two tracks. Operational efficiency in retail and this new kind of capital allocation, almost investment management strategy, on the side.
You could definitely frame it that way. Intense focus on costs and margins alongside this unconventional treasury strategy.
So thinking about all this, the profitability shift, the cost cuts, the huge cash pile, the move into Bitcoin, here's something to chew on. Given this massive cash position and their clear willingness now to allocate capital outside of traditional retail, how might GameStop's fundamental identity change over the next year or two? Could we see it lean more towards being a holding company, managing a mix of retail operations and financial assets like Bitcoin, rather than just being a retailer? And what would that imply for its future?